Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor, period. Let's get 1 minute on the shot clock here. Locked and loaded. Stock of the day is, in fact, no drama, or maybe some drama. It is Nvidia. We're seeing shares under pressure here. Nvidia is saying it's taking a $5.5 billion charge as the Trump administration barred it or put restrictions on it from selling its powerful AI H20 or H20 AI chip in China. So the stock under pressure there as well. Interesting that many on the street that I have talked to have expected this news coming. Still, shares are down. I think this news provides two warnings for investors. First, the China and U.S. remain very far apart in terms of reaching a trade deal. That is something that I was reminded of sitting right across from Treasury Secretary Scott Bessent in an interview on Tuesday. You can go to Yahoo Finance and check that out. They haven't even begun talks yet to get a deal done. And that comes with, of course, risks to companies that sell stuff in China, such as Nvidia. And last but not least, I mentioned that even though this news was expected by the street, still to see the stock decline, I think in this environment, the reminder is that maybe nothing, not all bad news is priced into a stock, especially a market leader like Nvidia. So buyer beware in many respects. All right, let's go from stocks to fixed income, another area of the markets that are very much in focus here. Kathy Jones, Chief Fixed Income Strategist, Charles Schwab, is here with me at the NASDAQ in Times Square. Kathy, good to see you. It's been a while.
Thanks for having me.
You've been quite busy, I imagine, the past 2 weeks.
Yeah,
fixed income getting its moment in the sun, as it should.
As it should.
So much focus on where the 10-year Treasury has moved the past few weeks. I believe it touched 4.5%. From your vantage point, what has been driving this? And is that 4.5% number, is that really a big deal?
I think what we're experiencing is a loss of confidence in the policy because, it was disturbing to see yields go up and the dollar go down at the same time in a week when the inflation numbers came in better than anticipated. So something else was going on. And there's a lot of talk about leverage trades coming unwound, but why would they come unwound? I think the reasoning is that the policy mix is just not coherent for people. So I think there's really a lot of confusion about which way we're going, what the tariffs are meant to accomplish, whether the tariffs are in place, not in place, for how long.
I mean, you just get like a shrug. They're out there.
Exactly. So I think we have this problem with confidence in the market, and people just don't know where to go. And when they don't know where to go, they just sort of sit on their hands and say, I'll go to cash and wait and see what happens.
Do investors not view the U.S. as a safe haven anymore?
I think that's going too far. I think people do view the U.S. as a safe haven, and we have seen yields kind of settle down now as the trade talks unfold. But I think we're not doing ourselves a lot of favors right now with picking fights with some of our closest creditors. So, we have to tread carefully because these are people who hold our securities. And not just bonds. I mean, a lot of foreign capital has flowed into the U.S. for investment purposes and equities as well as into bonds. And if we're having conflicts with our investors, that is a risk to the market.
I had as I mentioned at the top, I sat down with the Treasury Secretary, Scott Bessent, and I asked him, of course, China's second largest holder of treasuries, and I asked him, what if they started selling treasuries? And he didn't want to go too far down the rabbit hole, as you can imagine, but he did say, if China were to weaponize treasuries, the Fed and the Treasury would respond. Are you worried about China selling treasuries?
I don't think that that's a high probability. I think China's very smart about the way it handles its strategy around these investments. And so I think what we're seeing is China take other steps. Because if you have an asset and you force down the price of that asset, you're hurting yourself. And they also then have to deal with the currency implications of that. So it's not probably in their own best interest to do that. It's kind of the last resort. But it is something that China can hold out in these negotiations and say, well, by the way.
And it's something that hasn't been in play. That fear that they would weaponize treasuries treasuries has been around for many years, but now it seems more important than ever. Let's say they do. They don't aggressively dump treasuries, but they do unload some. What are the ramifications to the U.S. economy and U.S. markets?
Well, presumably, if it's a slow moving event, then what happens is yields go up. We have to find other buyers for that debt as our deficit goes up, probably pushes the dollar down, and that's not great for the economy. It's not great for inflation. So it would produce a bad mix. But I think what the Treasury Secretary is probably alluding to is that the Fed could buy bonds and be the buyer of last resort and hold them on their balance sheet. That is kind of a last resort on the U.S. side, something we did with quantitative easing during the pandemic and during the financial crisis. I think that might be the response he's alluding to.
If you mentioned that this may have been some speculative trades unwinding, that's what I heard from the Treasury Secretary. Is that trade done, unwinding on the street?
It certainly appears to be done. Not that there might not be other leverage traders out there that might need to liquidate. But at this stage of the game, yields have settled down into a range. And frankly, we're back to levels we've been at. We've been in this range for a month or two, back and forth and back and forth. So it looks like things have settled down, yeah.
What would you compare what we're going through today to other periods in your career? Is this what we're seeing in the bond market? Would you quantify it as a crisis?
I wouldn't say it's a crisis. I don't think there's anything comparable in my career.
Which says a lot.
I've been doing this a long time.
We've been doing this a while.
I've been doing this a very long time, and I've been through several crises. You know, the long-term capital management situation, the bursting of the tech bubble was around during the Volcker years when yields went up to 20%. So
can you imagine 20% yields
yeah,
today?
that was wild. That was wild. Although you could get a CD at 17 and a half.
That's a positive, but inflation was ripping people's faces off.
Yeah. So it's just different. But every I always say it's like recessions, that they're all unique. Every big event has its own unique qualities. And so sometimes we like to look back and say, oh, well, this is the average of these events or recessions or whatever, but there's no average recession. This one, if we are going to have a recession, is more due to the trade war than a typical sort of credit cycle or something, or an exogenous event like COVID. So it's just different.
I encourage everyone, just Yahoo search. Yahoo search Paul Volcker, inflation and yields, especially if you're under 30 years old. Go research these things. But I think a lot of younger investors have gotten to this viable, yields are only in this range and they do this thing and stock prices only do this. Let history help you dictate what you do in the markets today and into the future. History, of course, is very important. You mentioned recession, though, and a lot of folks are saying that what is happening in the bond market is signaling a recession. Are you in that camp?
I think the probability of recession in the next year has gone up quite a bit. I wouldn't say it's at levels where we'd be convinced there's a recession. You'd need a probability of over 50%, maybe 60% or so. I don't think we're there. I think we're in the 35 to 45% region. But again, a lot of it depends on policies as they play out. If we go into a full-blown trade war, then the probability of recession will rise. And I think the market's trying to discount that. But it's just really hard because we don't get consistent signals on what's going on. And there's so many things going on at once. So you have the Doge cuts and funding for institutions like universities. That has a widespread impact on the labor market. And if the labor market deteriorates, then we could see a recession because consumer spending would pull back.
Well, a lot of these colleges too, Kathy, as you know, they have large endowments. I mean, they own fixed income. Are these cuts impacting, are you hearing anything about these cuts impacting how endowments invest in fixed income?
No, I haven't. I haven't heard any change from the endowment side or the institutional side. I think the bigger question is when, say, the NIH cuts come through, that affects the private. So for every federal worker, there are estimated to be 2 private contractors. And the NIH funds and National Institute for Health, if you cut the funds there that flow through the university, you're cutting jobs associated with that. So I think these cuts could have a bigger impact on the labor market than people recognize. And if they continue, as they appear to be, if the funding continues to dry up, then we are going to see more weakness in the labor market that could cascade us into a recession.
Is there anywhere I can get this 20% CD? Because you're just setting up a backdrop that would suggest, like, I don't know, maybe I need more safety in my portfolio.
Well, I still think bonds are safe, and you can get 20% out of the question, but you can get anywhere from 4.5% to 5.5%. In very high quality bonds, investment grade corporate bonds, treasuries, other government securities. You can look to the municipal bond market if you're a high tax bracket, and a lot of people here in New York City pay a fair amount of taxes.
Yes, they do.
And the yields on long-term municipal bonds of very high credit quality are very high on a tax equivalent basis. So there are places to invest, and relatively safely.
All right, hang with us, Kathy. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. And, usually we talk about stocks and even crypto sometimes in Opening Bid, but I wanted to lock and load on fixed income. And for that conversation, you have to reach out to Kathy Jones, like we did, Chief Income Strategist at Charles Schwab. I want to go down or tick through the different types of bonds. Corporate bonds, what's their risk right now given the trade war? Like even credit-worthy companies, how concerned should an investor be about putting money to work in those type of bonds?
Yeah, we think investment grade is still solid. Corporate profits have probably peaked for the cycle, but over the years, these big companies have termed out their debt, meaning they've locked in lower cost of funding over a number of years. And so even in a downturn in the economy, they usually have strong balance sheets, enough earning to pay their bondholders. So investment grade, we feel pretty good about. The high yield below investment grade,
it's dried up.
Yeah.
I think I just read a story, I believe, in the Wall Street Journal that there's been no high yield issuance in the past few
right,
weeks.
because the markets haven't been particularly receptive. So and the spread versus treasuries is very wide, or not very wide, but it has widened significantly. And these are the smaller companies, more leverage, more debt on the balance sheet, more susceptible to the ups and downs of the economy. So we're pretty cautious on high yield. We think there will be an opportunity to go into high yield where you get enough yield to warrant the risk. We don't think we're quite there yet.
I want to drill down further in this. So you mentioned investment grade safe. So many companies, even investment grade, could have their profits completely wiped out this year, next year, and maybe even the year after because of tariffs. So how safe is safe?
Well, remember, bondholders have a legal right to their principal back and their interest payments before stockholders or dividend holders. So we think that by and large the bigger companies will be able to pay their bondholders. Whether they cut their dividends or their earnings aren't so good is another question. But for bondholders, I think we're in good shape.
You think dividend cuts are next?
Oh, I don't know. I mean, it's going to depend on the industry and the company. But again, this is not really a credit cycle where this is driven by over-leveraged companies getting overextended and then getting hit with a downturn. This is a different kind of a slowdown.
If riskier companies can't get the debt they need, what do we see? Rolling bankruptcies?
You start to see defaults and bankruptcies and restructurings. Now, a lot of what we've seen over the last several years is private credit funds have taken up some of the lower quality companies. So you get these, and they do restructurings where it's a distressed exchange. You get equity instead of debt. But that's more on the private credit side. On the public side, what you'd get is probably some sort of restructuring, but it depends on the covenants that are involved with the issuer. but you could see some defaults and some bankruptcies.
When you talk to international clients, or really, I guess, any clients, Kathy, do you hear any of them questioning the U.S. creditworthiness?
There's a lot of questions, and there's a lot of concern. We've sort of heightened concerns about long-term problems with our deficit and our debt. Now, over the years, it never has reached a crisis level because people believed in the full faith and credit of the U.S. government.
And all this stuff gets punted to the next generation.
Right, exactly.
So, they'll take care of it.
Right. And as long as the U.S. economy is growing at a healthy rate, then we can sustain, right? So it's unsustainable in the long run. It's sustainable in the short run if we're growing and we have, a healthy, strong economy. It's when you hit these downturns, what's our capacity now to deal with a downturn in the economy? Usually the fiscal side kind of kicks in to provide unemployment insurance and other kind of help when we're in a downturn. Now we maybe don't have that fiscal space to do it because we've spent a lot of money on other things, accumulated a lot of debt.
When I talked to the Treasury Secretary, we got into briefly the Trump tax plan. Now, he told me that some form of deal, or maybe the whole plan, will be done by July 4th. Now, as part of any deal, my interpretation is that we will add potentially trillions of dollars more onto the deficit. How would the bond market take that? In terms of, if we get that tax deal, the market digs into the details, they see trillions of dollars added to the deficit, where's the 10-year go?
Yeah, I think on the margin, it keeps yields higher. So the sort of three drivers of the Treasury market typically are, what is the Fed doing, what's inflation doing, what's the economy doing. The deficit has never factored in a big way, but there is a risk premium embedded in longer term bonds, particularly Treasuries, called the term premium. And that has expanded recently, and I think that it continues to expand if we pass that kind of a budget deficit bill. I think that term premium will push up longer term yields. People will question, well, how are we going to do this in the long run? So yeah, another big expansion of the deficit on the presumption that tax cuts boost economic growth. We've done this before. Yeah, we've done this where we cut our revenue and we increase our spending, and you can only do it so many times before the market starts to send yields up and says, we're not buying it.
Is it, given that backdrop, does it make sense to invest in Treasuries? Should I have a portion of my portfolio in them?
I still think it's part of what we call our core bond holdings. And yeah, they are backed by the full faith and credit of the U.S. government, which I think at the end of the day, if they have to take special measures to pay, they will pay. So I still think it makes sense to have treasuries.
In the last portion of our podcast, Kathy, we always love to get a hot take from our guests. This one, just pulling these out of thin air, Kathy, someone wanted to invest in bonds or fixed income today. What's the most important thing they need to know based on your many years of covering this space?
Just know what you own. The bond market's huge, and we talk a lot about treasuries, but the bond market's ginormous, as the kids say.
There is life beyond treasuries.
Right, yeah, and understanding the different types of bonds so you can have a really well-diversified portfolio is important. So just so many times I see people say, well, I bought this fund or I bought this ETF and I thought I was buying XYZ and I ended up with ABC. So just know what you own. I think that's the most important thing.
How has the past 2 weeks been for you and your buddy Liz Ann Saunders over at Charles Schwab, also a friend of Yahoo Finance?
Yeah, we've been busy. we've been communicating a lot and we've been very busy, but it's, sometimes times like this can actually be fun as well as scary.
Mm-hmm. Are people as nervous as we see reading the tape in the market when you talk to them?
Yeah, a lot of investors are nervous. There's just a lot happening at once. It's hard to interpret. It's hard to sort it out. It's hard to keep up. There seems to be something new every day from all over the world. And so, yeah, I think people are a bit nervous. We're not saying people make rash decisions so much as just ask a lot of questions.
Like what's the best question you're getting from them, or the most recurring?
I think we've gone from, should I just go to cash because I'm nervous, to what are the opportunities? So I think people are readjusting their outlook and saying, okay, we may have some ups and downs, but volatility produces opportunity.
I think years ago they would have just went all to cash, right?
Yeah. We might have. I mean, there's always a component of that, if people get nervous. And that tells you, look, if you're tempted to go all to cash, that tells you maybe your portfolio isn't structured the way it should be, right? Your risk tolerance isn't what you thought it was, which is fine. But that tells you a lot about yourself as well as about the market.
So true. We're going to leave it there. Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Good to see you. Tell Lizanne we said hello. Always good to talk with you both. And that is it for the latest episode of Opening Bid. Like I always say, hit us with those 5 stars on all the podcast platforms. Thumbs up on YouTube. Love your comments. They keep me going. I always try to answer them. We'll talk to you soon.